Hey everybody, let's take a look at supplies expense. This is one type of adjusting entry. We're going to see this with Natalie and Cookies Creations. So this is similar to the pizzeria owner. If you saw my previous video about sort of intro to chapter 3, this is similar to taking pizza boxes throughout the month. Pizza box for a pizzeria owner. A pizza box is a supply to a pizzeria owner, okay? And what'll happen is every business owner is going to want to have a count on hand of their supplies at the beginning of the month, and then they're going to count the supplies at the end of the month. The difference between what you had at the beginning and what you have at the end is what you've used up, and that's called supplies expense. So let's look at an example where a supplies expense is increased by $1,500. That means the business owner has used up $1,500 worth of supplies. I should mention here, this means that business owner is tracking their supplies carefully and closely. But let's imagine a small business owner who is doing this very basic count of what they have on hand versus at the beginning versus the end of the month. And if it helps, think about something as basic as paper and tracking maybe the number of reams of paper at the beginning of the month. Maybe a business owner has 10 reams of paper at the beginning of the month. By the end of the month, they have 1 ream of paper, which means they've used up 9 reams of paper, okay? And if they know that each ream of paper costs, let's say, $2, then they've used up $18 worth of paper, okay? So it's kind of that basic of a computation that we're doing here. So in this example, we have a business owner who's used up $1,500 worth of supplies expense. Here's how we show that from an accounting perspective. The actual asset of supplies is decreased. Okay, so we have the decrease of an asset, and we recognize this as supplies expense on the equity side. So we have an asset going down, which is a credit, and we have an expense going up, which is a debit. Okay, so now we're seeing our debit credit logic is really going to come into focus here. This explains this idea is explained here that we have debits increase expenses and they decrease assets. So if it helps, go back to your notes, maybe rewrite out your notes in terms of our T accounts showing an asset going down and an expense going up. Okay, it's here on the slide, but it might help to rewrite it using the notes that you've already gotten used to and then kind of how you're thinking through this process. In terms of the journal entry, so an adjusting entry like this is always going to be at the end of the month. So what we're going to do is we're going to show supplies expense being debited. Okay, so the expense is being incurred and supplies is being credited. The posting to the ledger, we're going to show a credit to supplies, right? And this is really just, again, the ledger is kind of just repeating what's happening in the journal, but we have to make sure we hit both accounts. So we're going to credit supplies and we're going to debit supplies expense. This debit and credit will, of course, also flow through to the adjusted trial balance. Okay, so that's an example of supplies expense.